In January 2018, Carillion entered compulsory liquidation. It held billions in public sector contracts. Thousands of jobs were affected. Pension obligations were left underfunded. The company had reported stable revenue. Profit forecasts reassured investors. Long-term contracts were recognized aggressively. Cash flow lagged behind reported earnings. Debt accumulated. Margins were thin. When project costs increased, impairments exposed financial fragility. Refinancing options narrowed. The collapse was not triggered by a sudden recession. It was contract accounting masking structural leverage inside a low-margin infrastructure business. Carillion operated as a major UK government contractor. Its core business centered on infrastructure and public services. The company managed construction of hospitals and schools. It maintained highways and rail infrastructure. It provided facilities management for public buildings. Revenue was heavily linked to long-term public sector contracts. These contracts extended across multiple years. Many agreements involved public-private partnership structures. Payment schedules were tied to performance milestones. Revenue visibility appeared stable due to contract duration. The company expanded through acquisitions. It integrated regional service providers into its structure. Outsourcing contracts became a significant revenue component. Facilities management generated recurring service income. Infrastructure construction generated project-based revenue. Public clients represented a substantial portion of total turnover. Dependency on government spending was embedded in operations. Margins were structurally thin across many contracts. Competitive bidding emphasized price efficiency. Winning bids often relied on tight cost projections. Contract complexity increased over time. Project oversight required detailed forecasting. Cash inflows depended on milestone certification. Working capital requirements fluctuated by project phase. Large projects concentrated risk in individual contracts. Revenue concentration increased exposure to public policy cycles. Infrastructure delays affected payment timing. Operational scale required centralized financial control. Board oversight depended on reported contract performance. Forecast revisions were common in long-term projects. Profitability relied on disciplined cost execution. Balance sheet assets included receivables from government entities. Payables included subcontractor obligations. The business model required constant project turnover. Pipeline visibility was used to reassure investors. Contract backlogs were presented as stability indicators. Accounting assumptions shaped reported earnings. Risk allocation clauses varied across agreements. Fixed-price contracts limited margin flexibility. Cost overruns were not always immediately visible. Contingent liabilities existed within project guarantees. Public reputation reinforced contract awards. Credit facilities supported working capital cycles. Short-term borrowing bridged payment timing gaps. Revenue recognition followed percentage of completion methods. Reported profits reflected projected final margins. Cash realization occurred later in the project lifecycle. Operating leverage remained embedded in fixed overheads. Thin margins required accurate forecasting. Dependence on public contracts created structural exposure. The model functioned smoothly during execution stability. Minor disruptions had disproportionate impact on profitability. Structural takeaway: revenue concentration in long-term public contracts increases dependency risk.
Carillion pursued growth through aggressive contract expansion. Management prioritized scale across infrastructure sectors. Bidding activity increased in competitive tenders. Projects were secured at narrow margin thresholds. Winning bids often undercut competitors. Volume was emphasized over margin resilience. Market share became a strategic objective. Revenue growth supported equity valuation. Backlog size was highlighted in investor communications. Contract awards were treated as performance indicators. Thin margins required strict cost discipline. Execution risk was embedded in pricing assumptions. Fixed price agreements transferred risk to the contractor. Contingency buffers were limited in competitive bids. Forecast profit depended on flawless delivery. Scale increased operational complexity. Multiple large contracts ran concurrently. Project management capacity was stretched. Central oversight relied on reporting accuracy. Cost escalation risk accumulated across projects. Cash commitments expanded with new awards. Working capital requirements increased. Subcontractor dependency intensified. Payment timing varied by project stage. Revenue recognition advanced ahead of cash receipt. Aggressive bidding reinforced growth narrative. Margin compression reduced tolerance for error. Debt capacity supported expansion strategy. Credit ratings depended on forecast stability. Investor expectations aligned with continued growth. Internal controls required precise forecasting inputs. Contract variations introduced scope changes. Claims and counterclaims affected profitability. Project delays strained financial projections. Earnings targets were reaffirmed publicly. Management confidence influenced market perception. Profit forecasts assumed margin recovery. Growth masked operational fragility. Incremental contracts increased aggregate exposure. Risk diversification was limited across sectors. Infrastructure concentration persisted. Competitive dynamics rewarded low pricing. Governance oversight depended on executive reporting. Board reliance on forecasts increased. Thin margin strategy amplified volatility. Minor cost shifts eroded projected profit. Growth strategy compounded financial sensitivity. Capital allocation favored expansion. Margin discipline weakened under scale pressure. Operational leverage increased across divisions. Structural takeaway: growth without margin discipline compounds fragility.
Carillion applied percentage of completion accounting. Revenue was recognized based on project progress. Estimated total contract value shaped reported earnings. Forecast costs determined margin recognition. Profits were booked before full cash receipt. Assumptions projected final contract outcomes. Management judgment influenced revenue timing. Small forecast adjustments altered reported profit. Long-term contracts required multi-year estimates. Accounting models translated engineering milestones into revenue. Cost-to-complete projections were central inputs. Optimistic assumptions increased near-term earnings. Loss recognition could be deferred by revised estimates. Early-stage profit recognition boosted financial performance. Cash flow did not mirror reported earnings. Receivables increased as revenue was recognized. Unbilled revenue accumulated on balance sheets. Forecast revisions required board approval. Internal controls reviewed assumption changes. Auditors evaluated percentage of completion methodology. Disclosure notes summarized contract risk exposure. Profit margins depended on cost stability. Forecast margins were embedded in guidance. Investor confidence relied on earnings continuity. Accounting transparency depended on assumption clarity. Project performance metrics influenced financial reporting. Late-stage cost increases required impairment recognition. Earlier revenue recognition amplified volatility. Contract modifications affected revenue schedules. Working capital absorbed uncollected earnings. Cash realization lagged accounting profit. Short-term liquidity depended on credit facilities. Profitability metrics diverged from cash metrics. Board reporting emphasized earnings stability.
Forecast-based accounting reduced immediate loss visibility. Assumptions were updated periodically. Impairment charges reflected forecast deterioration. Revenue timing influenced leverage ratios. Reported margins shaped refinancing negotiations. Credit assessments considered earnings quality. Percentage of completion required consistent oversight. Profit margin forecasts influenced executive incentives. Accounting estimates masked operational stress. Profit smoothing reduced apparent volatility. Cash strain emerged before earnings decline. Contract accounting amplified forecast dependency. Financial fragility accumulated gradually. Market perception relied on reported stability. Earnings continuity masked cash imbalance. Structural takeaway: early revenue recognition can distort risk perception. Reported profits remained positive. Operating cash flow weakened. Earnings suggested stability. Cash balances suggested strain. Receivables increased steadily. Unbilled revenue accumulated on the balance sheet. Working capital absorbed reported profit. Milestone payments were delayed on certain projects. Subcontractor payables extended payment cycles. Cash conversion lagged accounting recognition. Debt bridged timing gaps. Credit facilities supported liquidity management. Interest expense continued regardless of cash inflow timing. Dividend payments were maintained. Reported earnings covered distributions. Free cash flow did not. Short-term borrowing increased to stabilize liquidity. Net debt rose incrementally. Profit margins remained thin. Minor delays amplified cash pressure. Forecast profit did not convert to cash. Bank covenants referenced earnings metrics. Liquidity metrics tightened beneath the surface. Board reporting emphasized profitability. Cash flow statements received less attention externally. Analyst coverage focused on revenue growth. Working capital volatility increased across divisions. Advance payments were limited on fixed-price contracts. Retention balances delayed cash realization. Supplier relationships absorbed timing stress. Operational execution required upfront expenditure. Cost overruns reduced cash headroom. Earnings forecasts assumed recovery in later stages. Cash deficits appeared earlier in the cycle. Debt funded operational gaps. Interest coverage ratios narrowed. Credit rating agencies monitored leverage. Liquidity buffers became thinner each quarter. Accounting profit masked cash dependency. Forecast revisions did not immediately alter earnings. Impairments were deferred until contract reassessment. Balance sheet receivables expanded relative to revenue. Payables supported temporary liquidity. Structural leverage increased without immediate visibility. Cash strain intensified before profit warnings. Refinancing became increasingly necessary. Operational performance volatility translated into liquidity volatility. The divergence between earnings and cash widened. Confidence relied on reported stability. Underlying cash weakness accumulated quietly. Liquidity fragility preceded public recognition. Structural imbalance existed before market reaction. Structural takeaway: earnings without cash signal structural imbalance. Carillion financed operations with layered borrowings. Debt supported thin margin contracts. Net debt increased over successive reporting periods. Credit facilities bridged working capital gaps. Revolving credit lines stabilized liquidity. Short-term instruments supplemented bank loans. Interest obligations accumulated steadily. Earnings volatility affected covenant headroom. Leverage ratios were sensitive to margin changes. Thin operating margins amplified financial risk. Debt was not excessive in isolation. It was excessive relative to margin resilience. Interest coverage narrowed incrementally. Refinancing depended on stable forecasts. Credit ratings relied on projected earnings. Any impairment reduced covenant flexibility.
Cash generation was insufficient for rapid deleveraging. Dividends reduced retained earnings capacity. Capital allocation favored continuity over reduction. Balance sheet leverage increased without headline alarm. Analysts referenced backlog stability. Banks monitored liquidity metrics. Short-term debt maturities required periodic renewal. Minor forecast downgrades increased refinancing risk. Operational execution volatility translated into leverage volatility. Operational setbacks had disproportionate financial impact. Debt layered on fixed-price contracts increased sensitivity. Cost overruns compressed available margin. Interest expense remained fixed. Profit cushions were limited. Leverage amplified minor execution errors. Earnings guidance reassured creditors temporarily. Liquidity forecasts assumed performance normalization. Working capital absorption persisted. Debt funded the timing mismatch. Covenant calculations relied on reported earnings. Market confidence supported ongoing access to facilities. Rating outlook revisions signaled rising concern. Credit spreads widened gradually. Refinancing discussions became more frequent. Board oversight focused on maintaining facilities. Management emphasized resilience publicly. Cash strain reduced optionality. Leverage magnified forecast dependency. Minor accounting adjustments influenced covenant headroom. Financial flexibility narrowed incrementally. Debt servicing reduced strategic room. External confidence underpinned liquidity. Leverage embedded fragility into operations. Operational volatility now carried systemic risk. Structural takeaway? Leverage amplifies minor operational volatility. Carillion carried significant defined benefit pension obligations. Multiple pension schemes remained underfunded. Actuarial assumptions projected long-term recovery. Funding contributions were structured over time. Liabilities extended decades into the future. Discount rate assumptions influenced reported deficits. Asset performance affected funding ratios. Pension deficits competed with operational capital needs. Cash contributions were negotiated periodically. Trustees monitored covenant strength. Deficit recovery plans relied on future profitability. Weak cash flow constrained funding flexibility. Debt obligations held contractual priority. Pension funding depended on sustained earnings. Balance sheet disclosures summarized deficit exposure. Off-balance sheet perceptions understated liquidity impact. Credit assessments included pension liabilities in risk analysis. Board oversight included trustee engagement. Market participants evaluated total obligation burden. Low interest rates increased present value of liabilities. Volatility in asset returns affected funding gaps. Contribution deferrals increased long-term pressure. Profit forecasts supported recovery assumptions. Liquidity planning incorporated staged payments. Operational setbacks strained funding capacity. Pension headlines influenced investor confidence. Government contracts did not guarantee pension security. Trustees sought assurance of financial resilience. Covenant reviews considered total leverage, including pensions. Underfunding reduced strategic flexibility. Cash flow weakness limited accelerated funding. Debt refinancing did not resolve pension exposure. Long-term liabilities constrained short-term liquidity. Earnings adjustments did not alter funding reality. Pension deficits magnified leverage optics. Contribution schedules required negotiation during stress. Public scrutiny intensified under funding uncertainty. Pension risk increased reputational exposure. Financial statements disclosed aggregate deficits. Forecast improvements assumed cost stability. Cost overruns threatened funding assumptions. Liquidity buffers were shared across obligations. Stakeholders evaluated solvency, including pensions. Balance sheet leverage understated total liability load. Pension deficits reduced creditor comfort. Recovery depended on operational margin recovery. Market confidence required belief in earnings normalization. Deficit exposure became part of credit narrative. Long-term obligations narrowed immediate flexibility. Pension commitments limited restructuring options. Structural takeaway. Off-balance sheet liabilities weaken financial flexibility. Several major contracts began to experience cost escalation. Fixed-price terms limited margin adjustment. Forecast cost-to-complete estimates increased. Early-stage profit assumptions were revised downward. Impairment charges were recognized. Write-downs reduced reported earnings. Previously recognized profit was effectively reversed. Confidence in forecasting accuracy weakened. Construction complexity exceeded initial projections. Supply chain costs increased. Delays altered milestone timing. Contract variations introduced additional uncertainty. Claims processes extended resolution timelines. Loss-making contracts required immediate recognition. Cumulative impact exceeded earlier guidance. Board communication emphasized remediation plans. Revised forecasts projected stabilization. Impairments reduced equity. Leverage ratios increased mechanically. Credit rating outlooks deteriorated further. Investor skepticism intensified. Working capital absorption increased. Cash outflows exceeded inflows on specific projects. Subcontractor relationships tightened under payment delays. Performance bonds increased contingent exposure. Cost overruns revealed pricing fragility. Thin margin contracts offered limited buffer. Operational volatility translated into financial instability. Impairments compressed covenant headroom. Refinancing discussions became urgent. Forecast credibility declined. Earnings guidance was withdrawn. Share price reacted negatively. Market capitalization contracted sharply. Access to capital markets narrowed. Banks demanded enhanced reporting. Liquidity planning shifted to defensive posture. Dividend suspension was considered. Cash preservation became priority. Management turnover increased governance scrutiny. Audit oversight intensified review of contract assumptions. Negative media coverage influenced stakeholder confidence. Contract accounting now highlighted accumulated optimism. Cumulative adjustments exceeded incremental capacity. Liquidity stress accelerated. Debt servicing flexibility diminished. Public sector clients monitored project continuity. Government stakeholders evaluated contingency planning. Supplier exposure risk increased. Cash buffers eroded rapidly. Operational recovery required margin stabilization. Margin stabilization required cost containment. Cost containment required accurate forecasting. Forecast reliability had weakened materially. Structural fragility became visible. Structural takeaway. Mispriced risk materializes through cost overruns.
Carillion issued a series of profit warnings. Guidance revisions reduced projected earnings materially. Forecast margins were adjusted downward. Investors reassessed management credibility. Share price declined sharply. Market capitalization contracted within months. Equity volatility increased. Analyst coverage shifted tone. Confidence in contract accounting weakened. Earnings forecasts were no longer trusted. Credit rating agencies downgraded outlooks. Bond spreads widened. Refinancing costs increased. Banks requested enhanced covenant reporting. Liquidity concerns entered investor dialogue. Management communication emphasized stabilization plans. Remediation strategies were outlined publicly. Asset disposals were considered. Dividend policy was reviewed. Cost-cutting initiatives were announced. Board oversight intensified. Executive accountability became a focus. Audit scrutiny increased. Contract reassessments continued. Impairments reduced equity further. Leverage ratios worsened mechanically. Working capital pressure persisted. Cash conversion remained weak. Short-term liquidity required active management. Market skepticism hardened. Supplier confidence weakened. Subcontractors tightened payment expectations. Clients monitored execution risk. Public sector stakeholders evaluated continuity. Pension trustees sought assurance. Debt holders assessed recovery prospects. Equity investors priced insolvency risk. Share price declines limited equity-raising options. Capital markets access narrowed significantly. Emergency funding discussions were explored. Covenant headroom became critical. Forecast revisions accelerated distrust. Investor calls became defensive in tone. Board credibility was questioned. Governance oversight appeared reactive. Confidence erosion reduced strategic flexibility. Liquidity risk became central. Debt maturity timelines compressed in perception. Market discipline replaced prior optimism. Operational performance was no longer the sole issue. Capital structure became the dominant concern. Structural takeaway. Repeated guidance revisions accelerate capital market distrust.
Liquidity pressure intensified in late 2017. Cash balances declined toward minimum operating thresholds. Credit facilities were drawn more heavily. Banks required updated financial projections. Covenant calculations became increasingly sensitive. Impairments reduced available headroom. Refinancing discussions were initiated. Emergency funding options were explored. Asset disposals were revisited under stress. Market appetite for new equity was limited. Share price weakness reduced raising capacity. Government stakeholders were informed of risks. Public contracts increased political visibility. Confidence among lenders weakened. Short-term liquidity forecasting shifted to weekly cycles. Payment prioritization frameworks were implemented. Subcontractor obligations competed with debt service. Pension contributions were deferred where possible. Rating downgrades further restricted access. Bond investors demanded clarity. Negotiations with lenders intensified. Bridge financing was considered. Collateral discussions increased. Government hesitated to provide guarantees. Political scrutiny increased. Audit oversight accelerated review timelines. Management turnover signaled instability. Cash preservation measures were expanded. Capital expenditure was curtailed. Operational continuity plans were drafted. Board meetings increased in frequency. Liquidity risk overshadowed earnings discussion. Suppliers tightened credit terms. Subcontractor exposure risk rose. Working capital gaps widened further. Refinancing options narrowed further. Covenant breach risk increased. Lenders evaluated restructuring scenarios. Public sector exposure limited abrupt withdrawal. Confidence erosion became structural. Market perception aligned with insolvency probability. Cash outflows exceeded stabilized inflows. Debt servicing required lender cooperation. Emergency support negotiations failed to secure long-term certainty. Liquidity evaporated as confidence declined. Operational scale no longer protected viability. Credit support was conditional. Market access effectively closed. Board options narrowed to limited outcomes. Structural fragility translated into solvency risk. Structural takeaway. Liquidity evaporates when confidence weakens. In January 2018, Carillion entered compulsory liquidation. The UK official receiver assumed control. Operations were transferred to special managers. Public sector contracts required continuity planning. Hospitals and schools relied on active services. Infrastructure maintenance continued under supervision. Subcontractors faced immediate payment uncertainty. Employees experienced employment disruption. Pension schemes entered protection assessment. Creditors filed claims through formal channels. Bondholders assessed recovery prospects. Banks evaluated collateral realization. Shareholders were effectively wiped out. Equity value fell to zero. Government avoided direct bailout. Public funds supported operational continuity. Taxpayer exposure became a policy discussion. Project handovers required rapid coordination. New contractors were appointed. Supply chains were reorganized. Contract novations transferred obligations. Financial statements reflected insolvency status. Debt recovery expectations declined. Liquidation clarified asset value. Receivables were reassessed conservatively. Work-in-progress valuations were reduced. Impairments became final rather than provisional. Governance failures were investigated. Parliamentary inquiries examined oversight. Audit practices faced scrutiny. Board accountability was questioned. Executive compensation was reviewed publicly. Credit rating agencies finalized default classification. Market participants reassessed contractor risk broadly. Public procurement practices were debated. Contingent liabilities became visible. Pension deficit implications intensified. Liquidation exposed interdependencies across projects. Operational disruption highlighted systemic reliance. Infrastructure continuity required state coordination. Government departments absorbed transitional risk. Contract accounting assumptions were revisited retrospectively. Debt layering no longer masked fragility. Thin margins offered no resilience. Liquidity collapse formalized structural weakness. The business model proved unsustainable under stress. Scale did not prevent insolvency. Public exposure amplified consequences. Corporate governance limitations were exposed. Structural takeaway: systemic contractors create public risk spillover. Carillion's collapse followed a structural sequence. Long-term public contracts created revenue visibility. Revenue visibility encouraged expansion. Expansion relied on aggressive bidding. Aggressive bidding compressed margins. Thin margins reduced tolerance for error. Percentage of completion accounting accelerated profit recognition. Profit recognition preceded cash realization. Cash flow lagged behind reported earnings. Working capital absorbed accounting profit. Debt bridged timing gaps. Leverage layered onto narrow margins. Pension deficits added long-term liability pressure. Cost overruns reversed earlier profit assumptions. Impairments reduced equity. Equity reduction increased leverage ratios. Credit ratings deteriorated. Refinancing flexibility narrowed. Profit warnings weakened investor confidence. Share price declines reduced capital raising capacity. Liquidity planning became reactive. Banks reassessed covenant headroom. Market access tightened. Emergency funding proved insufficient. Confidence erosion accelerated liquidity strain. Operational scale did not offset structural weakness. Accounting contracts delayed visibility of stress. Forecast optimism deferred loss recognition. Thin margin infrastructure amplified volatility. Debt magnified operational instability. Pension obligations constrained flexibility. Governance oversight relied on reported forecasts. Forecast reliability weakened under cost escalation. Board confidence proved dependent on accounting inputs. Public contracts created systemic exposure. Liquidation transferred risk to the state. Shareholders absorbed total loss. Creditors faced impaired recovery. Employees and pensioners faced uncertainty. Infrastructure continuity required public intervention. The model depended on precision forecasting. Minor deviations produced disproportionate impact. Cash weakness preceded insolvency. Leverage converted volatility into solvency risk. Confidence supported liquidity until it no longer did. Accounting presentation could not generate cash. Governance frameworks did not prevent structural imbalance. Infrastructure scale did not guarantee resilience. Contract-based earnings masked margin fragility. Low-margin leverage proved unsustainable. The collapse reflected structure interacting with stress. Corporate failure was mechanical rather than sudden. Structural takeaway. Infrastructure contractors operating on leverage and forecast-based accounting are structurally vulnerable to minor margin shocks.